People hear employee stock purchase plan and think it's either free money or a tax minefield. The truth is calmer than both, but you do need the right mental model. By the end of this video, you'll be able to open your ESPP plan and your brokerage screen and answer 3 things. What the discount is actually worth, what parts are taxed like income versus investment gains, and which 3 signals tell you whether you're about to get surprised on your paycheck or your tax return. This is general education, not financial advice. Let's use one simple scenario and keep coming back to it. Say your company offers an ESPP with a 15% discount and a look back. You contribute $500 per paycheck. After 6 months, your contributions total $6,000. On purchase day, you buy shares using that $6,000. Here's the first thing to get straight. The discount is a built-in price advantage, not the same thing as profit. And the look back can make that advantage bigger because the plan may use the lower stock price from either the start or the end of the offering period. So let's translate the discount in numbers. Imagine the stock was $80 at the start of the offering period and $100 on purchase day. With a look back, many plans let you buy at 85% of the lower price. The lower price here is $80, so your purchase price is $68 because 85% of 80 is 68. With $6,000, you buy about 88 shares, since 6,000 divided by 68 is about 88. If the market price is $100, that's a $32 per share gap, or roughly $2,800 of built-in value. That's why ESPPs are powerful. The mechanism is real. It also explains why taxes can feel confusing, because a big built-in gap can be treated partly like income even if you never intended to trade. Here's the clean way to think about ESPP taxes. There are usually 2 buckets. Bucket 1 looks like compensation. Some portion of the discount gets treated as ordinary income. Bucket 2 looks like an investment gain or loss. That part depends on what the stock does after you buy. The annoying part is that your brokerage might show one gain number, your W-2 might show another, and your tax form might show a third. None of those screens are lying. They're measuring different buckets on different dates. 2 plan dates drive the whole story. Date 1 is the offering start date, because that can set the look-back price. Date 2 is the purchase date, because that's when your cash turns into shares. Then there's a third date that matters to you, the day you sell. Selling is what forces the accounting to show up on paper. Without getting lost in jargon, there are 2 outcomes most people face. Outcome 1 is a quick sale, sometimes the same day the shares hit the account. In that case, the built-in discount tends to show up more like income, and many people notice it through withholding or a W-2 line later. Outcome 2 is holding the shares. The discount and the later price movement can get split across different tax buckets, and the paperwork becomes easier to misunderstand. Here's the mechanism chain that creates most ESPP confusion. You contribute from payroll. You buy at a discounted price. Your broker reports a cost basis number that might not include the income-like portion. Your employer may include part of the discount in wages. When you sell, the 1099-B shows proceeds and a cost basis that may need an adjustment. If you do not reconcile those pieces, it can look like you're being taxed twice. Let's put a clean number on the part people actually feel. In our scenario, you bought at $68. Suppose you sell later at $95. Your broker might show a $27 per share gain, because 95 minus 68 is 27. On 88 shares, that's about 2,376. Separately, a portion of that built-in discount can be treated like income. The exact slice depends on the holding rules. The key is not memorizing the rule from memory. The key is knowing what to check so your forms line up. So, what do you check first? Check number 1 is your plan summary. You're looking for 4 lines: the discount percentage, whether there's a look back, the offering period length, and any sale restrictions like blackout windows. Check number 2 is your brokerage tax lot details for the ESPP shares. You want the purchase date, purchase price, and reported cost basis. Check number 3 is your pay stub or W-2 around purchase time. If your employer reports the discount as compensation, wages can be higher than you expected, and withholding can jump. If you don't see it there, it doesn't automatically mean you owe nothing. It just changes where the reconciliation happens at filing time. Now, a quick counterpoint. Another reason this might not show up right away is that employers handle reporting differently. Some people see the income portion clearly on the W-2. Others only see the mismatch when they enter the 1099-B and the numbers don't match. So the practical way to frame it is, you're not guessing. You're using receipts and screens to identify which bucket you're in. Picture someone who joined a company mid-year. They enroll in the ESPP because the discount looks like an easy win. 6 months later, the purchase happens, the shares show up, and they sell to pay a car repair. The cash arrives, but the next paycheck is smaller than usual because withholding jumped. Then tax season comes, and their software flags a cost basis mismatch. Nothing illegal happened. The forms just need to be aligned. Also, remember the practical friction here. Some plans have blackout windows or a required holding period before you can sell. Even when you're allowed to sell, it can take a few days for shares to settle and for cash to hit your bank. That timing matters if you were counting on the sale to cover a bill. Notice what ESPP really touches in your wallet. It's jobs and income, because the money comes out of your paycheck and the discount is part of compensation. It's taxes, because the split between income and gains changes with holding and filing outcomes. And it's budgeting, because the cash flow is steady out, then lumpy back in when you sell. Next, we'll build a simple decision table for selling versus holding that stays in the education lane. Then we'll finish with 3 signals you can watch so you don't get surprised by withholding, by cost basis, or by concentrated risk. Let's keep the same scenario. You put in $6,000 over the offering period. You bought around 88 shares at $68. The market price is floating. Now you have to decide what this really is in your life. Most people accidentally treat ESPP like both a savings plan and an investment at the same time, which is how you end up surprised. A better way is to put it into a decision table based on one variable, how dependent your monthly budget is on that money. If you need the cash within the next 30 to 90 days, the main risk is not missing out on upside. The main risk is the stock moving against you before you can use the cash, plus timing friction, like blackout windows and settlement. If you do not need the cash and you're comfortable with more volatility, holding can make sense as an investment decision. But then you have to own the concentration risk. You already work there. Your income and your stock exposure are tied to the same company. That's the intermediate so what most people skip. An ESPP can quietly double down on the same risk. If something hits the company, you can get both a job shock and a portfolio shock at the same time. Now, let's translate that into 2 paths without telling you what to do. Path A is treat it like a discount capture. That means you're basically using ESPP as a structured way to buy at a better price, then converting to cash quickly. The trade-off is you give up potential upside if the stock runs. The benefit is you reduce concentration and you reduce the chance that a short-term stock dip turns your discount into a loss right when you needed money. Path B is treat it like a longer-term holding. That means you accept the company's stock exposure and you accept that the tax character can get more complex. The trade-off is volatility and concentration. The benefit is you participate in longer-term price movement. Notice what's missing here. The right choice is not about being smart. It's about matching the plan to your timeline and your risk stack. Now, let's talk about the 3 signals that keep this from turning into a surprise later. These are not vibes, they're screens you can check. Signal 1, your contribution rate versus your cash floor. Where to look, your payroll portal or ESPP enrollment page, and your monthly budget cash cushion. What direction means? If contributions are pushing you close to 0 before your next payday, you're increasing your odds of overdrafts, late fees, or using high-cost credit. Typical timing. You feel this within 1 to 2 pay cycles. It's immediate. In our scenario, $500 per paycheck is great until the month your car insurance renews, and that same paycheck is also covering a higher escrow payment. If your cash floor is thin, the plan can create stress even if the discount is real. Signal 2, the look back and purchase price gap. Where to look? Your plan's purchase confirmation and the stock price at offering start and purchase date. What direction means the bigger the gap between your purchase price and market price, the more built-in value you're creating, and the more likely there will be an income-like component to reconcile. Typical timing. It updates each purchase, and you can estimate it the day the purchase happens. In our scenario, buying at $68 when the market is $100 creates a large gap. That's good economically, but it's also the exact setup that makes tax paperwork feel weird. It's not a reason to panic. It's a reason to expect reconciliation work. Signal 3, cost basis reporting versus wage reporting. Where to look: your W-2 wages and any ESPP compensation line items, plus your brokerage 1099B cost basis for the sale. What direction means? If your employer included part of the discount in wages but your broker's cost basis does not reflect that, your tax software can show too much gain unless you adjust. That's the fake double tax feeling. Typical timing: you see wage reporting at year end, and you see brokerage reporting after you sell, usually around tax season. In our scenario, if you sell those 88 shares, the 1099B might show proceeds and a cost basis based on the purchase price. If wages already included some discount amount, you may need to reconcile so you do not pay tax twice on the same slice. Now, the practical part. What should you do this month in 2 minutes to reduce the chance of surprises? First, pull your plan's one-page rules. Do not rely on memory. Look for the discount, look back, offering length, and any restrictions on selling. Second, open your brokerage lot details for the last purchase. Screenshot or note purchase date, purchase price, and the reported cost basis per share. Third, check your pay stub around purchase time. Did your taxable wages jump? Did withholding jump? If yes, you learned something important. Your employer is likely reporting part of the discount as compensation. Fourth, run one quick stress test on your cash flow. If contributions are $500 per paycheck, and you have a month where 2 annual bills hit, can you still stay above your cash floor? If not, the plan might be a good deal that still needs a better timing system. Finally, do a concentration check. Add up how much company stock you already have from ESPP and any other grants. If it's getting big relative to your other investments and cash, you are increasing the one company risk stack, whether you meant to or not. Now let's bring it back to the person who sold to pay the car repair. If they had checked Signal 1, they would have known whether contributions were making their paycheck too tight. If they had checked Signal 2, they would have expected a big built-in value and anticipated tax reconciliation. If they had checked Signal 3, they would have saved themselves the panic when the tax software looked like it was taxing the same gain twice. In the final block, I'm going to give you a tight checklist you can run every purchase cycle, plus the clean receipt set you want to keep, so tax season is boring instead of stressful. Here's the 2-minute checklist to make ESPP predictable. 1. Open your ESPP plan page and confirm 4 items. Discount percent, look back, yes or no, offering period dates, and any sell restrictions. If you cannot find one of those, that's the first problem to solve. 2. On purchase day, write down 2 prices, the look-back price used and the actual purchase price you got. Then note the market price at close. That gives you the built-in gap in one glance. 3. Within a week after purchase, check your payroll history. If taxable wages or withholding looks different than a normal check, flag it. That's your hint that some discount value is being treated like compensation. 4. If you sell, pull the lot details and keep the sale confirmation. You want proceeds, purchase price, and reported cost basis. Later, when you receive the 1099B, you'll compare it to what you saved. If numbers do not match what you expect, it's usually a cost basis reconciliation issue, not a mystery tax. 5. Run a concentration check. You do not need a spreadsheet to start. Just ask, if this stock dropped 30% next month, would that wreck my plan? If the answer is yes, you've learned something real about your risk stack. Now the receipt set that makes tax season easier. Keep your plan enrollment terms. Keep your purchase confirmations. Keep your sale confirmations. And keep one screenshot of the lot's purchase price and cost basis. Those 4 receipts cover almost every "why does this form look wrong?" moment. If you want a clean takeaway, it's this. ESPP value is real, but it's not magic. It's a discount plus timing, and taxes are just the accounting of that discount and what happened after you bought. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns, and leave a comment with the next topic you want covered, Or the one part of today's video you want explained even simpler.